Mutual fund investors typically invest for medium to long-term goals. Faced with a sudden need for funds, investors tend to redeem investments. But guess what? Investors can actually seek loan against their investments. But how should you go about seeking these loans? What are the criteria that investors must fulfill to seek loans against their investments? Let's understand all of this with Aditya Agrawal, co-founder, Wealthy.in. Aditya, good evening. Welcome to the show. So, although taking loan from your investments sound like a very tricky thing, after all, you are accumulating money for a particular financial goal. And between that, if you have a financial crunch, and I think this should be the last resort one should be looking at, in breaking their investments. But having said that, what kind of financial assets are we talking about when it comes to taking loan on your investments? Can you just list that out first?
Investments can be borrowed against. So you can borrow against your stocks portfolio, you can borrow against your mutual fund investments, you can borrow against your FDs, even, you can even borrow against your savings insurance policies. And today, I think because we have a big ESOP movement in the country, today there are companies that can even give you loans against your ESOPs in a company. So all kind of financial assets possible, you can actually borrow against those financial assets.
Now, what's important is I want to understand who are eligible for this. I mean, are we talking about Indian investors? We're talking about NRIs investors? What's the formality that gets into it?
Yeah, I think so. All kinds of investors, whether you are an individual or a non-individual, you can borrow as long as those investments belong to you, right? And I think, for example, if we talk about investments like stocks or mutual funds, typically if I have stock investments and if I want to borrow, let's say from a bank, then typically those banks will want that my stock investments have to be in their custody, as in my demat account should be in their custody. I think that's requirement number one, because if my investments are in their custody, they can actually lien mark them and say that these units or these shares are borrowed against, so that I cannot redeem them from anywhere else. So typically, when you talk about capital market investments like stocks or mutual funds, I think that's the typical first requirement of the lending institution, that they should be able to lien mark your units. And typically people want that their existing investments should be with them only to be able to lend to you, right? But there have been some developments there. Today, I think we have seen some developments where, for example, your mutual funds might be direct, but you can still borrow against them. Fintech companies are actually trying to build solutions where wherever your investments might be, you should be able to borrow from, even if your investments are with institution A, you should be able to borrow from institution B.
All right, let's talk about various aspects because one needs to understand it's not only mutual funds you're talking about. Is it possible to even take loan on your insurance policies?
Definitely. So if you have a savings insurance policy, for example, LIC, or let's say any savings insurance plan, you can actually borrow against that policy as well. It's slightly complicated, the calculation, because there is a concept called surrender value. So let's say if you are paying 5 lakh rupees premium every year, and let's say you've paid your premium so far for 4 years. So in those 4 years, your policy would have accumulated some surrender value, right? And that surrender value is typically lower than the premium that you have paid. So you can actually borrow against that surrender value. And in fact, insurance companies, LIC especially pitches that as a solution, because LIC's most of its investors or savers are, small savers. So they pitch it very aggressively. Like I know that my nanny, I helped her actually take a loan against a LIC policy from the LIC branch.
So let's understand this with an example, because a lot of Indians, I think, more than mutual funds, have insurance policies, and here we're talking about traditional insurance policies. Okay, so let's just dive deep into this.
Sure.
Explain this to me to an example, and taking a traditional life insurance policy under consideration. If someone wants a loan of say 50 lakhs, and they've got a policy that gives them a sum assured for like 10 to 15 lakhs after a certain period of years, how does it go about?
Yeah, so I think, let me reverse it a bit. Let's say I'm paying 5 lakh rupees a year for a savings insurance plan, right? And let's say I have to pay it for next 20 years. And I'm in year 10th. And year 10th, I have paid so far 50 lakh rupees for that policy. Now, in that year 10, my policy would have accumulated some surrender value, right? Let's assume that surrender value is typically by year 10th about 70% of what you have paid, right? So my policy has acquired a surrender value of 35 lakh rupees. So I go to my insurance company provider, let's say it's LIC, for example. I go to LIC and say that this is my policy. It's accumulated so much surrender value. Can you please provide a loan to me against it? And LIC, if you go to visit a branch, they'll be happy to assist you in providing a loan which can go up to 70% of your surrender value. So in this case, if your surrender value was 35 lakhs, you probably will get a loan of about 22 lakhs to 22 lakh rupees on that policy.
And how is the
Because as you know,
repayment?
it's very hard to break an
Sure.
insurance policy in between. So it
Exactly.
serves as well.
Yeah. So, and what will be the repayment strategy? How do you repay that? Because you've taken a loan and you're also
Right.
paying the premium. Is that the repayment strategy? Is there any added percentage in the premium that needs to be given?
Yeah, so it's like any other loan. So
Okay.
for repayment period will definitely be lower than the remaining period that you have for your premium, right? So for example, if I have 10 more years left for my premium, so maybe I'll get a 7-year loan. That 22 lakh rupees might be a 7-year loan that I have to repay on a regular frequency, just like I would repay any loan against my property, right? If I take a loan from a bank.
Percent of at what rate is the loan given?
So that rate can depend, right? So for example, someone like LIC might lend you at 10%, right?
Oh,
But NBFC might lend you at 12%.
okay.
So the rates are, because, rates, these are treated like personal loans. So they are not really, a loan against. So they're typically cheaper than personal loan, but more expensive than a home loan. That's the way to look at it.
And what happens if there is a lapse in just repaying any installment here, or that's equal to lapsing your premium amount?
Yeah, I think so. That's great because in LIC or in a savings plan, you have already paid them, let's say 50 lakh rupees or 50 lakh rupees in this case in 10 years, right? So they already have some money from you, right? And that's why the policy has accumulated a surrender value, right? So whatever they are paying to you is actually as a loan would be lower than that surrender value. So to that extent, they're actually paying you as a loan lower than the asset, the value of the asset that you have at that point in time.
All right. So, can these loans be taken against your term insurance plan also? Because
No.
that's the modern insurance policies, life insurance policies. No,
Yeah. No,
not
term insurance, no, because term insurance is a protection product, right? So
sure.
it's
Right.
there in
Totally.
case of if you are not around. So term insurance is no such, it's not a savings product. It doesn't grow in value, right? So it's not really an investment. So you can only take loans against products that are actually a saving or investment in nature.
All right. Let's talk about PPF. How does that work? You have a lock-in for like 15 years, and maybe after a few years there can be a partial withdrawal also. But then what about taking a loan on the amount that you've accumulated in a PPF or a PF, both?
Yeah, so there again, so it sort of depends. I think one thing that probably hasn't sort of hasn't sort of developed. It's not as developed a market, just like a loan against property. So we are still seeing models emerge where people can actually borrow against their financial assets easily. But in case of PPF, typically you can only borrow from the institution where your PPF account is, right? And EPF, we have not really seen a lot of instances where people are able to borrow against EPF because it's a complicated. EPF is in custody with your EPFO, right? So how do you sort of give that custody to a lender? So I think in EPF, we haven't seen a lot of successful implementations of to be able to borrow against your EPF balance. Or in case of PPF, you can definitely borrow in PPF against the, wherever you have an account, that PPF account, you can borrow from the same organization or same institution against that PPF.
Amount, and the loan amount will depend on your accumulated amount, or that's a separate thing?
So if it's a debt-like instrument, right? If debt, as in like PPF is a debt-like instrument, it will not really go down in value. So there you can expect about 60 to 80% of your accumulated value in terms of loan, right? Just like how your property, right? You can take up to 80% of your property value. But if it's an equity investment, then typically the ratios are lower.
Let's talk about another favorite investment instrument that Indians have, which is fixed deposit. Now, how does that work?
Yeah, same way. So if I have fixed deposit with, let's say, Bajaj or a bank, I can borrow against it, right? And yeah, the loan against fixed deposit is probably the most straightforward, right? Because you have a bank, you've done a fixed deposit with them, and you can just get as a collateral and borrow against it. So that probably is the simplest of all instruments in terms of taking a loan against.
And there is no additional amount to be taken. Whatever is the amount that you fixed, you will be given a loan equal to that amount, or you can just go higher or demand a higher amount as
No,
well.
you can't. It will have to be lower than the total value of your assets.
Okay.
Just like how your properties, right? If I have
Right.
1 crore home, I'll probably not be able to borrow for more than 70 lakh rupees, right? So I think the same principles apply. But as I said, the market is not as well developed as like loan against property. Everyone understands today, right? All
Exactly.
understand.
Yeah.
But loan against investments is still sort of, it's like I would say penetration is very, 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 very low right now.
Exactly. Also because people need to have an investment strategy first in the first place to understand that loan can be taken on it. But then let's move on and let's talk about shares and stocks. I will come on mutual funds in the end once again. But how does a stock portfolio loan on your stocks actually work?
So let's example, for example, I have an investment account with, let's say, a bank A, right? I have a demat account where I've actually in demat account I've bought some stocks, and I go to that bank A and say that, I have a 1 crore stocks portfolio, and I have need of 20 lakh rupees to, let's say, build another floor, of home, right, in my at my home. So, bank might say, okay, great. You have these stocks with us. We will lien mark them. You can't sell them from anywhere. Yes, and continue to earn any dividend on those stocks, but you can't sell those stocks anywhere. And let's say your requirement is 20 lakhs. So they might say, okay, up to, let's say, 50 lakh rupees of your total stock portfolio as of today is what we are lien marking, right? So that you can't take any action against those stocks for until you repay your loan.
All right, let's talk about mutual funds because here a major amount of literacy is really needed. So, how do you take a loan on your mutual fund units? Considering that you've invested maybe for a medium term, say 5 to 6 years, and there's a financial crisis, do you have to count in as per units or the investment cycle that's gone into it? What would be the criteria of taking a loan?
Yeah, so I think, let's say I am an investor, a mutual fund investor, and I have a mutual fund portfolio of, let's say, 30 lakh rupees across 3 schemes, right? And 3 schemes, and each one of them has some units. And I go to a bank, again, a bank, right? And I tell them that, these 30 lakh rupees of investments I have, I need a loan of 15 lakh rupees, right? So I think the first thing they will see is that whether my investment is all equity or it is equity plus debt. Because on equity investments, as I said, I get a lower ratio, right? So if I have 30 lakh rupees of just equity portfolio, I might not be able to get a loan of more than 15 lakh rupees, right? And then just like how stock works, then, essentially they will confirm my unit balances, right? And then they will lien mark those unit balances. So even when, for example, if you have taken a loan against your mutual fund, right, if you download the statement, it will show a line as lien marked. So what that means is essentially, right, that those units are lien marked to a lender. Just like, for example, if you borrowed a car, I don't know if you borrowed for a car ever, but when you borrow a car, the RC says hypothecated to a bank. So similarly here, your mutual fund investments will say lien marked to a particular bank, and and after that it just works as stocks too, right? So your units, those particular units are lien marked. You cannot do any operation on them. You cannot do any withdrawals on them. You cannot do any switches on them. But yeah, if there is a dividend coming from those units, that will keep coming to you.
All right, I think that will be all. Thank you so much for helping our viewers today and helping them understand how to take loan against their investments today.
Thank you, Kavita. Pleasure being here. Bye.
Welcome back. As per the latest data by the mutual funds during January and March, equity mutual fund inflows fell by 23% to $5.9 billion from $7.7 billion. The latest data showed investors have turned cautious due to prolonged weakness in the domestic equity market in the wake of global uncertainties. Let's understand more about this with Jayesh Faria from Motilal Oswal Private Wealth. Jayesh, good evening. Welcome to the show. So as compared to FY22, FY23 and specifically the last quarter showed 23% dip in the inflow across categories in equity mutual funds, and in the last quarter, especially in the month of March, we saw a very high figure in debt mutual funds looking at considering the change in taxations involved. Now, talking about the dip in last 1 year, financial, if I have to consider, do you think investors have turned really cautious, and it's also the volatility that's making them take this attitude?
That's right. Thank you, Kavita, again for having me on your show, and a warm welcome to all your viewers. And as you rightly said, yes, the data point shows that Q4, this last quarter of the financial year, we are seeing dip in equity flows in comparison to the last financial year. And as you rightly said, I think the major factor where we have seen more inflow in debt is because of the change in taxation. But there are other two important parameters as well. I think Indians realize that low interest rate scenario can hit us. As you know, thanks to growing economy and inflation always being high in our country, we were all used to first double-digit return on our debt investments or fixed instruments, and slowly it settled around 8 to 9%. COVID is the first time where we have seen as Indian investors earning 5.5%. The favorite investment option, which is bank fixed deposit, first time Indians seen that it can also deliver only 5.5%. So if you look at another major reason why we have seen this change is interest rates in India have gone up. And because interest rate in India has gone up, that instrument or a fixed deposit or a fixed income instruments look more lucrative vis-a-vis equity market. So I think that's one reason where we have seen more inflow into fixed income instrument in comparison to equity. Second big reason has been the equity market for nearly 21, 22 months have been flat. They have been very range bound. Net investors haven't seen any great return. It's been a single digit return or many cases negative return. That is another reason where people were not very upbeat in this quarter about investing into equity funds. And these are two major reasons where you've seen dip in inflows in comparison to last financial year. Of course, the good news is we were still positive. It's not that we have seen redemptions. The inflows have been coming in, but the quantum of inflow for both these quarters have changed, Kavita.
If we have to just focus on the different categories across equity mutual funds, so where exactly are we seeing a deeper dip?
And that's very interesting data. When we looked at the data, if you look at the last quarter investment in last financial year, the majority of the categories which received money, nearly 50% of them has been large cap, flexi cap, or a combination of large and mid caps is where we have seen more than 50% of inflow. If you look at this year's data is completely different. We have seen inflows coming in sectorial funds, thematic fund, one of the category which was forgotten by investors in last couple of years, which was dividend yield fund. In fact, dividend yield fund has seen the maximum inflow in this quarter. So that indicates that investors are one becoming choosy. Second, they are not believing into large market because I think all of us feel that P ratios of large cap are still at closer to all-time average or above all-time average, indicating that our equity market is in a fair value zone. They are not cheaper nor they are expensive. In comparison to that, a small cap or a thematic fund which is shown vis-a-vis their all-time average P ratios have been attractive and investors have been choosy and they have allocated more funds towards this avenue vis-a-vis a broader market.
When we look at the mindset of an investor, do you think it's also because they think that the market is more stock specific and theme specific, which is why thematic funds and sector funds are catching up, and also even dividend yield funds, because as you rightly mentioned, there's been a sudden investment trend in these kind of funds. So what is the investor mentality?
So if you look at the majority of the investors, and we manage large assets, so when we look at our set of investors, which are high net worth and ultra high net worth individuals, there is a change. As I mentioned, because markets have been flat, and the narrative has been that this is the first time index funds have beaten active fund managers in India, and that has happened because concentrated on few stocks in index doing well, where majority of the portfolios of clients are not reflecting the same, because active fund manager did not invest exactly as index, or they've been away from those couple of stocks, and that's why investors have not seen the same performance in their portfolio, and that is one of the reasons where they have moved towards the specific funds. Coming to dividend yield fund, because interest rates have gone up, that's looking attractive in terms of fixed income instrument, and change in taxation, because after the debt mutual funds not being able to take an indexation benefit, I think from a taxation angle, people are looking at dividend yield as an option to a debt fund, because their again focus of investor is to earn higher dividend through this fund and take a taxation which is much lower than the fixed income instrument, and that's why you're seeing a renewed rigor towards these funds.
Then now the dip in equity mutual fund inflow, and we very well dissected that and tried to make sense behind this dip and investor attitude. Do you think this is going to sustain? And even though we are in positive right now, do you think there's some kind of a concern in coming quarters looking at these numbers now?
So if you look at, and as I mentioned, that inflows are still inflows. We are negative positive. We are net positive and not negative. So that trend towards equity investing, I think, is here to stay. And as I mentioned, the taxation change in debt, Because if you look at the inflow in debt fund, normally in quarter 4 of every financial year, thanks to corporate giving advance tax and people deploying their money or doing the strategy on their money during the last quarter, we have always seen an outflow in debt. If you compare that also vis-a-vis last financial year, we have reduced at 50%. Last year, we've seen 1,18,000 crore of redemption across debt mutual fund, which this year has been less than half. It's been only around 52,000 crore. So that also indicates that people are deployed money to take advantage of the taxation change which was happening from 1st April, and they invested into that money before 31st March. But coming back to your question, I think equity habit or allocation to equity is here to stay. We may see a flow reducing, which we are already experiencing. But in my view, I don't think that trend will turn negative anytime soon.
That's some optimism coming. Thank you so much, Jayesh, for being on the show and helping our viewers today.
Pleasure to be on your show. Thank you very much, Kavita, for having me.
We move on. The Money Show. There are plethora of funds available in the market to invest your hard-earned money, but how do you assess which is the right fund for your portfolio? What are the criteria that one should look at? To help you navigate through this maze, we have on board Harshvardhan Rupta, CFP Rupta Securities. Also, do not forget to send us your portfolio queries on our WhatsApp number, which is 865-797-4571. You can also email us your queries on the Money Show at etnow.tv. Good evening, Harsh, and welcome to the show. And we have our first viewer online with us, Nilesh. Hi, Nilesh, can you hear me? All right. I don't think we have him on the call, but then his question is there. He's investing in mutual funds for last 5 years, and he's accumulated a corpus of 5 lakh in last 4 years. He wants to pay off his education loan of 15 lakh in next 5 years. He wants you to suggest some funds, and he's also looking at investing 20 to 30,000 per month.
Kavita, ideally, if he had shared his existing portfolio with us, maybe we could have suggested some increment in his existing scheme itself, because he says that he's been investing since about 4 to 5 years now. Nevertheless, he intends to pay off his education loan. That is what he has mentioned in his query, and he wants to invest about 20 to 30,000. And he has a 5-year horizon again. So I guess he can definitely choose equity as an asset class to invest into. And I think when he accumulates that kind of money, he can think of part repaying or full repaying his education loan. In case the markets don't do well after 5 years, he can just continue investing, and as and when he gets a positive return on his portfolio, he can at that point in time repay his education loan. So I'll give him 2 schemes, considering I don't know his existing portfolio. However, I'll give him 2 schemes so that he can consider investing them for this purpose. So one is SBI Multi-Cap Fund, in which he can put a 15,000 every month, and Canara Robeco Emerging Equity Fund. In this, he can put another 15,000 and continue for 5 years. As and when he gets the corpus accumulated, he can part repay or full repay the education.
Right. We move on to our next question. Suman has sent us his question, and he's 32 years old, and his monthly income is 58,000, and he wants to invest maximum of 20,000 per month in mutual funds. He wants to have a corpus of 70 lakhs in 10 to 15 years. Currently investing in PGI Mid Cap, SBI Magnum Mid Cap, SBI Small Cap, and he wants to know if he should be sticking to these funds for his corpus.
So Kavita, ideally, in my personal opinion, I do not think this is the right way of constructing a portfolio. So, and an investor should basically try and diversify across different market segments and also across different fund managers. So you have about 40 fund houses offering their services. Most certainly you could look at even diversifying across different fund managers to get the fund manager expertise as well. So what I suggest, he could invest in the following manner. He has these things, and just rejig a little bit. So SBI Small Cap, he continues as it is. PGI Mid Cap Fund, again, he continues. I'm just replacing one SBI Mid Cap Fund for a simple reason, so that he gets a fund house diversification. I've also retained the aggressive nature of his investment, but in a flexi cap strategy. So he could use an ICICI Proof focused equity fund in place of SBI Magnum Mid Cap. The rest, other 2 schemes, he could continue. Now, as far as his goals are concerned, in 10 to 15 years, he wishes to accumulate 70 lakh rupees. But I think in his current investment, he should be able to accumulate that comfortably.
All right, we move on and we take Deepak's question. He's been investing in mutual funds for 5 years now. He's collected 4 lakh corpus, and He wants a total of 50 lakhs in next 10 years to fund a property purchase, and he can invest 30,000 each month. He's right now investing in SBI small cap, SBI Magnum mid cap, Quant small cap. I think it's a similar set of funds in terms of categories. So a lot of investors are actually banking on mid cap, small cap, and this seems to be even the first choice of fresh investors. Harsh.
So Kavita, this actually kind of draws a concern for me. I mean, because mid and small cap category are good. It's not that they're not good investment segments. The only point is that have you understood the volatility that is associated with them? So most often, in all the queries that we take, we will realize that people have only looked at the past returns, the immediate past returns, thinking that the same kind of returns will replicate in the future as well. So that may not be true. So ideally, an investor should invest across different market segments and also allocate across different segments. So if you're a risk averse person, you might probably want to invest higher quantities in large cap and then little lesser in mid and small cap accordingly. So I think that's the right way. You should not assume that something that has happened in the past will continue in the future and get the same kind of return. So in case of Deepak as well, I'll make certain changes just for the sake of balancing the portfolio out completely. SBI small cap he continues, of course. Now, in place of SBI mid cap, again, only for the sake of diversification, fund manager diversification, he can invest into Kotak Emerging Equity Fund. So this is also an equity fund, mid cap equity fund, but from the Kotak Fund House. And Quant small cap, you replace that with ICICI Pru Focus Equity, again for the same reason that you will have a different fund house. At the same time, you retain the aggressive nature of the investment with a flexi cap strategy. So with regards to his target, which is 50 lakhs after 10 years, the current investment should enable him to accumulate that kind of thing.
Amit Suneja, and he has in total 8 funds. I think you have the list of his funds. He's got 2 small cap, he's got 1 multi cap, mid cap, large and mid cap, and flexi cap funds. He's got Balance Advantage Fund and Access Growth Opportunities Fund also. So he says that he's already 51 years old and he's been investing through SIP, and he wants to understand what could be the amount he can expect. He's talking about a maturity amount in terms of within 5 to 7 years, how much would he be collecting with this amount?
Yeah, so Kavita, 2 elements. One, of course, we will consolidate his portfolio a little bit. He's investing 72,000 rupees per month and 9 schemes. Mr. Amit, you must understand that at one point in time, there will be some coordination and administrative work between all the different schemes that you have. So better to just consolidate it, keep it simple, and just to reduce your administrative efforts that you will put in the future. So your 72,000 could be invested in such a way. All the 5 schemes that I'm going to name now are out of your existing portfolio. So you don't have to add any new schemes, just change the investment amount in each scheme. HDFC multi-cap fund, instead of 8,000, now you'll invest 12,000 in it. Parag Parikh Flexi Cap again at 12,000. Access Growth Opportunity Fund 12,000. SBI Contra Fund 12,000 and HDFC Balance Advantage Fund 24,000. So that's how your 72,000 is going to be invested henceforth. All the other schemes that you invested, just redeem out of them and consolidate into these 5 schemes itself. With regards to how much can you expect? Well, any investments that you make in mutual funds, whether debt or equity, there is no guaranteed return that you can assume, or even, it will be, you cannot really estimate what an equity will perform in the next 5 or 7 years. However, if you have to take some estimation and, try and get some ballpark figure, probably a 10 to 12% kind of a return, if you estimate between 5 and 7 years, is something that you can. And if this was to happen, you could expect a 55 lakhs to 85 lakhs within 5 and 7 years that you're looking at.
All right, last question, Rishi Baveja. And he's an NRI and looking for best ways to invest in mutual funds, stocks to save taxes, and he wants to know what will you recommend. He also has a regular rental income in India. So what should be his strategy?
Yeah, Kavita, NRIs can most certainly invest into India. There is no doubt, or into mutual funds more particularly. And since he wants to save tax, the ELSS fund offered by mutual funds can most comfortably be chosen to invest to save tax under ETC to the extent of 1.5 lakhs. Now, the only question arises, we don't know whether he's a US or a Canadian resident. Only in case you're a resident of US and Canada, there are certain restrictions in terms of not all fund houses accept investments from US and Canada residents. There could be some instances wherein a fund house will require you to be in India while you're investing. Some fund houses accept money even when you're not present in India physically. There could be a situation where only lump sums are accepted and SIPs are not accepted. But nevertheless, overall, to say that if you wish to save tax, you can invest into an ELSS fund and through mutual funds, and you can also take the advantage of equity over a longer period of time. So lots of options are available. It's not a problem. Just that you'll have to identify depending on your residency. In case you're not a US Canadian resident, then there is no problem at all. In case you are a resident of these two countries, then there is some restriction, but there are ample of options available which you can choose.
That will be all. Thank you so much, Harsh, being on the show today, helping our viewers with the financial portfolio queries. And on that note, it's a goodbye. I'm going to leave you with our WhatsApp number and email ID where we keep waiting for your questions. Thank you so much for watching. Goodbye.